Welcome to the deep dive. Okay, let's cut through the usual noise for a second. Something pretty significant just landed in the economic data. We're talking about an unexpected twist in wholesale prices. And this is the kind of thing that could actually ripple out and affect everything from, your grocery costs to your investment strategy. So our mission today is pretty straightforward. We're going to dig into the August 2025 Producer Price Index report. The PPI, we want to figure out what these numbers are really telling us. Is inflation genuinely cooling? What might the Federal Reserve do with interest rates next? And why did the financial markets react the way they did? We've gathered insights from, all over. We've got the official data from the Bureau of Labor Statistics, analysis from Reuters and AP News, plus market perspectives from Investopedia, FXStreet, ADM Investor Services, a good mix. Think of this as your, let's say, shortcut to getting up to speed. We'll give you a clear view on this complex indicator so you really understand what's going on behind the headlines. Okay, so let's unpack this. The Producer Price Index, or PPI, it's always a big one for people watching the economy. But maybe just quickly remind us, what exactly does it measure? And why is it considered such a leading indicator? What's the real power there?
Right. Well, what's really fascinating about the PPI is that it gives us this early signal, a kind of sneak peek at potential cost changes before they usually hit consumers directly. So simply put, it tracks the average change in prices that domestic producers get for their goods and services.
Okay. So prices at the factory gate, essentially.
Exactly. Think of it like watching inflation move through the supply chain. If manufacturers are paying less for raw materials, components, maybe even labor, that often filters down to what they charge retailers and then eventually what you end up paying.
Right. So it's a leading indicator because it shows pressure building or maybe easing kind of upstream in the economy.
Precisely. It's a critical look ahead.
And speaking of easing, this August report, it seems like it had some, genuine surprises. The headline number really stood out. We saw the main PPI for final demand actually fall by 0.1% in August. Now, how significant is that dip, especially compared to, say, July?
Well, that 0.1% monthly decline is actually pretty crucial. It's the first drop we've seen since, April 2025? And it's a really sharp turnaround from July's pretty big 0.7% gain.
Wow, yeah, that's quite a swing.
It is. And then if you look year over year, the annual PTI, it rose 2.6%. Now, that's still a rise, but it's noticeably down from July's 3.3%.
So definitely a cool down then.
A definite cool down, yes. If you connect this to the bigger picture, these numbers really suggest a noticeable easing in inflation pressure at that wholesale level. It's what economists call disinflation. Prices are still going up, but thankfully at a slower pace.
Right. And the key insight is that this slowdown before it hits the shops, that could prevent some pain down the line for consumers.
Absolutely. It's potentially good news. It means companies might not feel that same intense pressure to keep hiking prices relentlessly. It's like the market's first real sigh of relief on this front.
That does sound like a welcome change. But, the Fed, they never just look at the headline, do they? They always dig into this thing called core PPI. Can you explain that? Why is that distinction so important for them, and what might it be telling us?
You're absolutely right. Core PPI is critical for the Fed. It strips out the really volatile stuff, food and energy prices mostly, and also trade services.
Why those specifically?
Well, because those prices can swing wildly for reasons that have nothing to do with the underlying health of the economy, right? Think about bad weather hitting crops or geopolitical tensions messing with oil prices.
Okay, yeah. External shocks.
Exactly. So by removing those, the Fed gets a clearer, maybe more stable view of the persistent fundamental inflation trends, the stuff that's less likely to be just temporary noise.
So they can see if inflation is really embedded or just being pushed around by temporary factors.
Precisely. It helps them gauge the real underlying pressure.
Okay, so let's look at that core number for August. We actually saw another monthly decline there too, didn't we? Core PPI also dropped 0.1% month over month.
That's right, it did, which on the surface seems positive again.
Yeah, it seems like good news continues. But then we hit the year-over-year figure for core PPI. And that's where it gets, as you said earlier, a bit sticky. It actually rose 2.8% annually. And that's the highest annual core reading since March 2025. That feels contradictory. How do we square that circle?
That's a great question, and that's really where the nuance comes in. It's a bit of a mixed signal for sure. So yes, the monthly core figure cooled off, which is good, but that annual rise to 2.8%, the highest since March, that suggests the underlying pressures haven't completely vanished. What's potentially happening here is that this persistent 2.8% isn't about oil prices jumping around. It might mean inflation is digging into stickier areas, things like wages, especially in services, or maybe some embedded supply chain costs that are just harder to get rid of quickly.
I see. So stuff that doesn't change month to month quite so easily.
Exactly. And Fed policymakers are watching this very, very closely. They care about the headline, sure, but they are deeply focused on whether these core elements are truly coming down. That's what affects long-term stability.
So they can't just declare victory based on one good headline month.
Not at all. That 2.8% is like that stubborn bit of inflation that just won't quite go away yet. It keeps them cautious.
Okay, I like that stubborn cookie analogy you used before.
Yeah.
So with this picture-cooling headline, but this sticky core, what's the market thinking about the Federal Reserve's next move? Financial markets seem pretty decided, don't they?
They do. That unexpected drop in the overall wholesale prices, it really boosted market expectations for the Fed to, well, change course. We're seeing very strong bets now on a quarter-point interest rate cut, possibly as soon as next week's meeting.
Really, that soon?
That's the chatter. And there's even speculation about more easing, more cuts through the rest of the year.
And this isn't just about the PPI data in isolation, is it?
No, not at all. You have to see it alongside the recent softening we've also seen in the Consumer Price Index, the CPI, and personal consumption expenditures, the PCE data.
Right. Other key inflation measures are also pointing downwards.
Exactly. So when you put it all together, it builds a pretty strong case, at least in the market's view, for the Fed to start easing policy, to maybe take their foot off the brake a bit.
The thinking being that the economy might need a bit of a boost now, and maybe inflation is behaving enough for the Fed to act.
That's the collective sentiment, yes.
So what does this actually mean for the Fed's strategy then? I mean, you've got this overall trend pointing towards easing, especially month to month, but as you said, they won't just cut aggressively if that sticky core inflation, that 2.8% year over year, stays up there, will they?
No, they really won't. Their decisions aren't just about the headlines. They're trying to walk this very fine line. They want to bring inflation down to their target, around 2%, without completely slamming the brakes on the economy and causing a major slowdown or recession.
A delicate balance?
Extremely delicate. So a quarter-point cut, maybe that's on the table now. But a rapid series of deep cuts seems much less likely if those core numbers don't start cooperating more convincingly.
They need to see sustained evidence that inflation is truly heading down across the board, not just a diff here or there.
Precisely. They're looking for a clear, sustained downward path, especially in that core measure.
Okay, that makes total sense. They're playing the long game here. Let's shift gears slightly. How does this translate directly to, people's money, investments? How do the financial markets actually react to this specific PPI news? Were there clear winners and losers? What's the mood among investors now?
Well, the immediate reaction was pretty clear. The market heard potential Fed cuts and basically breathed a sigh of relief, betting on easier money ahead. Stocks, for instance. Stock futures climbed higher, adding to recent gains. That reflects a generally bullish or optimistic sentiment.
And why is that? Lower inflation equals higher stocks.
Generally, yes. Lower inflation reduces the pressure for higher interest rates. Lower rates make borrowing cheaper for companies, which can boost profits. Plus, lower rates make future earnings look more valuable today, which tends to lift stock prices, especially for growth companies.
Okay. And the bond market?
Similar story there. Treasury yields dropped quite noticeably. That reflects what we call a more dovish sentiment. Investors betting the Fed will ease policy, meaning lower rates in the future.
And when yields fall, bond prices rise.
That's right. Investors anticipate lower future rates, so existing bonds with higher coupons become more attractive.
Interesting. What about other areas, like gold or maybe even crypto?
Good question. Gold prices rallied. Gold often does well when inflation eases, and the expectation is that central banks might cut rates, making non-yielding gold relatively more attractive compared to bonds.
Okay.
And things like Bitcoin, other sort of riskier assets. They also tend to benefit when inflation cools and rate cuts look more likely. Again, it often encourages more speculative investment looking for growth.
So summing up the market reaction, it's pretty positive for risk assets in the short term.
Yeah, definitely. This kind of data creates a short-term bullish setup for stocks, crypto, gold, basically anything that benefits from the prospect of lower interest rates. Markets love signs the Fed might be able to cut.
Cheaper money fuels risk appetite.
Pretty much, yeah. It encourages betting on economic expansion.
Okay, so lots of positive market feeling right now. But are there potential bumps in the road? What could disrupt this nice picture of easing inflation and maybe impending rate cuts? What should we, and presumably the Fed, be keeping an eye on?
Ah, yes, the headwinds. That's a critical question. Can this trend actually continue? Despite the softness we just saw in August, our sources definitely flag some risks, things that could cause that headline PPI to bounce right back up later this year.
Like what?
Well, tariffs, for one. There's still an expectation they could add pricing pressure, particularly on imported goods. Then there's always the risk of unexpected energy shocks, geopolitics flaring up, driving oil and gas prices higher again.
We've certainly seen that before.
We have, and of course, new supply chain disruptions. We've all become, unfortunately, familiar with how quickly those can reverse progress on inflation.
So the advice is caution.
Absolutely. Traders, investors, they should probably stay cautious. If that core PPI number stays stubbornly high, around that 2.8% year-over-year mark, or, and this is key, if the next inflation report, the upcoming CPI data, surprises everyone by coming in hotter than expected.
Well, all that market optimism we just talked about, it could evaporate very quickly.
Right. The story isn't necessarily over.
Not by a long shot. These reports are just snapshots. The underlying forces driving inflation are still very much in play.
Okay, that really brings us towards the end of our deep dive today. It seems August's PPI data paints a really fascinating, though definitely nuanced picture. On the one hand, we're seeing a clear softening in wholesale inflation, particularly that headline number. And that's really boosting hopes that the Fed might start easing policy soon.
Right, and that's sent positive signals through stocks, bonds, even crypto markets.
But on the other hand, there's that persistent stickiness in the core producer cost that 2.8% annual rise. That remains a really critical signal that the Fed, and honestly all of us, need to keep watching very closely. It's the fly in the ointment, so to speak.
So here's something to think about as you go about your week. Maybe head to the shops or check your investment apps. Will you start seeing signs that these lower wholesale prices are actually making their way down to you, the consumer? And maybe consider this. The Fed is walking such a tightrope here. How do they balance giving the economy a potential boost with a rate cut against the risk of letting that sticky core inflation get embedded even further? It's a really delicate act with huge stakes for all of our financial futures.
It really is. A lot riding on their next moves.
Something to definitely keep pondering as this whole economic story continues to unfold. Stay curious, everyone. Stay informed. And we'll catch you next time on The Deep Dive.